Hello, everyone. Welcome back. It is very nice to be here again with you to share some thoughts from our compatriot from across the pond. Sharing thoughts really from a different view, which I am very happy to get the perspective from someone coming to us from England. We have the Chief Research and Investment Officer of Morningstar Investments, Daniel Kemp, joining us again. Dan has been gracious with his time and joins us again just before the presidential election to offer a perspective that other investment firms may not have, because he is looking at it from foreign territory as it applies to the U.S. So, Dan, thanks again for joining us. We really always appreciate you and giving us a couple of minutes.
Lou, it is great to be with you, and thanks for the opportunity. Very excited to get into this conversation.
You know, I believe it is exciting for you. Every time you come with a big smile and plenty of great information. So I'll just arrange this for everyone listening. And again, Dan and I do as we always do with these conversations. No charts, no graphs. We're having a good conversation, and you're joining us, so you can pour that cup of coffee as I've done and listen. We are going to talk politics because it is. 'Tis the season, as one client said to me. Interest rates, which are really top of mind and something that I think will impact the third part of our discussion, which is going to be an outlook for 2025, something that we can share, we can carry forward. I'll add a little bit of my perspective on that for how we're positioning clients. So, Dan, why don't we just jump into it? 'Tis the season for politics, okay, and the U.S. presidential election deservedly dominates the conversation right now. And every now and then, if you see my screen go black, don't worry about that. It's simply a technology glitch that is, I don't know, can't be fixed. I don't know what to say. So anyway, it's a very important topic, and that is understating it, obvious. But the perspective, if you will, from outside U.S. borders of U.S. politics at this moment, and again, no left, right. We're not worried about that. We're worried about how each of the candidates, each of the parties impact politics. And as I've led everybody up, so I'm asking you a couple of questions here. As I've led everybody up to this question that I've spoken to before, the impact of a presidential election year, statistically speaking, isn't all that impactful. However, until we get to this point where we can see the finish line, or at least the start-finish line in front of us, perspective from outside the country, the conversation that's going on, and Morningstar's position on the impact of a presidential election, and we will have a change of presidents coming up.
Yes, that is the big question of the moment. And Lou, as I think about this, the most important thing to say is that your founding fathers very wisely said that people from Britain shouldn't have a say on the U.S. election. And so I'm not going to dive into
You're not going to vote?
Aspects. I'll just think about it from an investor's perspective and how we think about investing through this environment. And the most important thing to say is that whenever we have a presidential election, and particularly one as close as this one looks, then there's a lot of uncertainty around. We see that in every conversation that we have with people. People are focused on the election. They don't know what the outcome is going to be. Although, as you said, we know there's going to be a new president come next year. And so there's a lot of uncertainty. And the way that people tend to react to uncertainty, we see this each presidential cycle, is that people tend to hoard their cash. And so they tend to not invest because they want to see the outcome of the election first. But of course, that means that people are often missing out on returns. If you'd started this process a year ago and you'd hoarded your cash, you'd have missed out on a pretty bumpy year in terms of returns. And so the challenge with hoarding cash is it might work for you in the short term, but we know that in the long term, it can derail you from reaching your financial goals. So when you think about a presidential election cycle, It's very easy to try and react to what's going on, but that can lead to bad outcomes. Another thing that people do is that they tend to align the financial outcome with their own political views. So we all do this naturally. We think that if the person we support is going to wins, then things will go well, and the person that we don't support wins, things will go poorly. And again, we get quite invested in that. And so when we're thinking about investing, when we're thinking about the outcome, remember it's important to disconnect your political views from what could happen in markets. And a great example of this is what happened to energy stocks under the first Trump presidency and also under the Biden presidency. So we know, if we know anything about Trump and Biden, that Trump is more in favor of traditional energy companies, oil companies, and Biden is more in favor of renewable companies. That's just part of their sort of backstory. Well, under Trump, we know that energy stocks actually fell by 38%, and alternative energy stocks, sustainable energy stocks, rose by 267%. And then under Biden, the reverse happened, that clean energy stocks fell by 53%, and traditional energy stocks rose by 145%. Now, we know that that's because there was a lot of other things going on at that point, but that really illustrates the point that when it comes to politics, there's always tons going on, even if the candidate that you didn't want to win does win. They're not necessarily in control of the agenda. They're not in control of what's going to happen economically. And so you have to disregard your political views, focusing from an investment perspective. As we do that, then there's not that much difference between the two campaigns in terms of what they're going to be able to do, as far as we can see from this perspective.
Well, I appreciate all of that. You give me an opportunity to talk a little bit about that application of personal beliefs politically affecting investments. I've said it to every client that works with Tranquilli Financial Advisor, Dan, left or right, it does not matter. We worry about how they impact our financial lives, and the policy that goes in place that will impact our financial lives. So I am in the business of detaching from it and working with clients to help them detach from it. It really leads to, it's why we don't speculate. And if we do speculate, if we come onto a video like this and you and I are having a conversation and we say, well, what do you think moving forward? Because we're going to do that later. It's based around a set of reasonable assumptions, not emotional or passion towards a political party or a person that may be running for president of the United States, or even local elections, which don't get enough credit as part of the impact that it has on our money. So anyway, the speculation of looking forward, but then also speculation, and I think this is a really important one. Pardon me, the current conversation about what taxes look like, and we really didn't cover this as we were preparing for our conversation today. But even at that, even taxes, the speculation of Kamala Harris wins the presidency and taxes go through the roof, or Donald Trump wins the presidency and taxes fall through the floor. We can't act on that. If we start acting on that right now, we could be selling or buying into a trap, and we just can't do it. We have got to work with facts that lead to a reasonable perspective moving forward. So I just wanted to add that piece to it because it really fits into the political conversation. There's so much speculation. There's so many talking heads. We've really got to filter through that because we have our financial lives to consider as part of this. Interest rates, speaking of financial lives. And I've said to a few other the previous conversations that we've had leading up to the presidential election, I really want Jerome Powell and the Federal Reserve to stop being rock stars. I mean, I really, really want them to get off of my television. Okay, that's all there is to it. Yeah, Powell comes out and says we're dovish. Someone else from the Federal Reserve out of the blue comes out and breaks ranks and says, no, I'm hawkish, and you're sitting and saying, when did this happen? Like, when did they become such rock stars? And I know when it is, and I've covered it with others. But let's just get to interest rates. Morningstar's perspective on where they will likely end up. Speaking of using history as a guide here and speculating interest rates long term, higher for longer, and what does higher for longer mean, both to the consumer or for the consumer in both borrowing and economic productivity.
Yeah, absolutely, and I agree that all of the sort of rock star central bank narrative is not helpful for end investors. It moves prices around. It doesn't help us make better investment decisions. So that's the first thing that I'd say, that we absolutely shouldn't be speculating or making investment decisions based on short-term interest rate movements. One of the things that we've seen with interest rates throughout history is that although they do move around on a moment-by-moment basis, and obviously the Fed makes their decision on what the short-term interest rates will be. Actually, interest rates tend to move in longer-term regimes, and it's very easy to spot these regimes and the turning points in hindsight, but it's not very easy to spot it with foresight. And so you can have years or sometimes even decades when almost nothing happens in interest rates. There's just a long period of stability, and then suddenly everything will change very, very quickly. And so we have to prepare. We shouldn't predict because that can get us into trouble. So as we think about interest rates, when we think about the future, we have to start with where we currently are. Where we are is that interest rates are pretty normal. That for your older clients, if you remember back before 2008, you'd look at a 4 or 5% interest rate. Yeah, that's pretty normal. That's what we've had. We had much higher rates in the 70s. They kind of came down in the 80s and 90s, but that's a pretty normal rate. You think of inflation at running, let's say just over 2.5%. You add a couple of percent onto that as a risk premium. You get to 4.5%. We're sort of normal levels. So we start from a point where interest rates aren't unusually high or unusually low, which is a decent starting point. But it does look like interest rates have been bringing inflation down, which means that they're probably acting as a bit of a brake on the economy, and the central bank doesn't like that. We want the economy to grow naturally, and so we're in this regime of interest rates being cut a little bit. But they're probably not going to be cut too aggressively when we're already starting at that normal point. Inflation is pretty normal as well. And so unless we see some big event that forces the Federal Reserve to change direction very, very rapidly. We've seen a few of those over the last 15 years, but unless we see one of those, then I wouldn't spend too much time trying to speculate on whether interest rates will go down a bit or go down a bit and then come up a bit. In reality, we've got an economy that's doing pretty well, it seems. We've got interest rates that are on more of a downward path than an upward path, and that's positive as background noise. But I would see where we are at the moment as being pretty fair, which is a little bit unexciting, but it's a reasonable time to be investing. It's not at one of those extreme moments where you tend to get the unusual outcomes.
No, I certainly appreciate the comment that it's a bit boring. You cannot believe the number of Tranquilli clients that have said to me, Lou, boring is good. Keep it up. All right. So let's have it. Let's just have the Federal Reserve fade into the background. OK, become the drummer, not the lead singer. OK, become the backbone of the band, if you will, the economy, rather than the lead singer, because it really enough is enough of that perspective of things. All right. And then let's wrap it up, because we want to keep these around 20 minutes so that everyone gets good perspective of what we're looking at and the conversations that we're having, and you and I directly at times, and of course other people within Morningstar with Tranquilli Financial Advisor. Outlook for 2025. We likely agree, and I did not check with you before saying this, so apologies. We likely agree this presidential election appears to be one that could be contested for some time after the November vote. So assuming we all calms and we head into 2025, there will be a president elected in the United States. It will happen. And now we're looking at the economy and the stock market, the outlook from Morningstar's perspective, from your deep research for the U.S. economy, for the U.S. stock market. Again, all predictions are subject to change, and of course they are opinions, not guarantees of any kind, and you shouldn't invest based on this. But with that said, that's part of our job, is we look forward and say, okay, where do we want to shift assets to? Your perspective of 2025, please.
Yeah, absolutely, Lou. And I think there's two things really. The first is that whenever we're thinking about investment, we're coming at it from a valuation perspective. We're quite old-fashioned. We love a bargain, and so we like it when prices are low and people are feeling down in the dumps. People feeling that there's a bad outcome. And we get a bit skeptical when everyone thinks that the road ahead is going to be perfectly smooth and upward, because that's not really how life works. That's right. So we start from that valuation view, and we always take a long-term view. So valuation really matters. It's not going to tell you what's going to happen over the next few weeks and months, but it exerts some gravity-like pressure over the long term. So when we think about your clients, of course, your clients, Tranquilli's financial advisor clients, are not investing for the next 3 months. You're investing for years, and so that long term works. And so when we got together in July, what I said about the future then was the market's probably going to be a bit broader and a bit bumpier. And then we had August, which was bumpy. And then we had September, the first part of September, which was bumpy. And now we've got an election coming, which might be bumpy. But that's just part of investing. That is a feature. It is not a bug. It is an opportunity to buy things more cheaply. And then when things get very overvalued, then to lighten up sometimes with holding. So when we look ahead, what we see is a market that's really split in two, to put it simply. We have a few companies that are very large and technology orientated, that look really quite expensive. And then we have a large number of companies that are smaller, they're in less fashionable areas, that look much better value. And that's quite a stretch between those two. And so as we look forward, there's plenty of opportunities for investors in some of those smaller, less fashionable companies. But at a headline level, again, the market may continue to be bumpy because those large stocks are overvalued, and there's a lot of positive sentiment. If that turns around, then we can see those stocks and the market as a whole fall. But plenty of opportunities. And then as we get outside the US, again, lots of opportunities outside the US markets where people have done less well over the last 12 months, where prices are lower, where the opportunities are there to invest. So there's opportunities wherever you look. That doesn't mean that the market's going to go up in a straight line. And so as your clients think about the election, as they're thinking about the months behind that, just remember that all of this noise, these ups and downs, that's just a normal part of investing. The key is to stay invested, to follow your advice, to get to the goal, and not to make any big decisions when we're feeling at our most jubilant or our most stressed. And that may happen to us over the coming few weeks.
I want to add so much more to that, but you said it so perfectly, Dan, that I don't have to. So thank you for that. Yes, I will restate the ups and downs. The volatility is a feature, not a bug. That's a great one. Might have to be the tagline for 2025 for Tranquilli Financial Advisors. So Daniel Kemp, the Chief Research and Investment Officer, Morningstar Investments. We always appreciate you. We'll do this again early in 2025, and we'll get to look back and say how right or wrong we may have been, but we will do so with our best efforts, having taken care of all this. So, Dan, thanks again. Always appreciate it.
It is an absolute pleasure, and I look forward to doing this again in January. Thanks.
All right, we will. So.